amazing run for the Aussie share market. 6 days of gains and the 6th week of gains as well. So it's been another positive week for the Australian share market, and that's despite the stumble that we saw from the Nasdaq and some of the high growth momentum stocks in between. If we have a look at our market, really if we have a look at the volumes today, they were quite strong, and they're the strongest that we've seen in around about 2 weeks, but that was related to stock options expiry. And if we have a look at the different sectors, it was still those defensive type of sectors which perform well. Those high yielding areas like the utilities and the property sectors were a standout. On the flip side, we saw the staples being sold off mainly as a result of Woolies and some profit taking there after Woolworths reached a record high earlier on in the week. And I guess our market also helped along by the aftermarket performances by the likes of Facebook as well as Apple, both which had a stellar performance after the market closed in the US on the back of quarterly earnings. Facebook up by almost 4%, and we saw Apple up by almost 8%. So we have seen the US futures positive throughout the Australian session, up by 0.2%, which has helped our performance, and we've managed to finish in the black for the 6th consecutive week and the 6th consecutive day. It has been moving higher, and in terms of valuations, while valuations are looking reasonable at the moment, you have to think of the market in cycles, and I guess most things move in cycles. And if you have a look at it in terms of the earnings cycle or the interest rate cycle, we're really at the beginning of this earnings cycle uplift, as well as interest rates potentially turning the corner from going down to going up. And usually if we have a look at the correlation between interest rates and the Australian share market, they do tend to go in the same direction historically. So as interest rates go up, the Australian market does tend to be going up. And of course the earnings cycle also looks like it's turned after a few years of negative earnings growth. We're now seeing some positive earnings momentum coming through. So it isn't unusual at this stage of the earnings cycle for the market to look relatively expensive, because the market's pricing in future growth, and we haven't seen that for a number of years. So while the market's looking reasonably priced, I think the fact that the anticipation that we are going to continue to see earnings growth is a positive for the market. And in terms of cycles, the market's looking a lot better than it has in the last 3 or 4 years. It is expensive, and the thing to remember is that this is a massive deal. Now, they've paid just over $7 billion, and Transurban has a market capitalisation of $10 billion, net debt of around about $5 billion. So it's a huge purchase for Transurban. Now, they'll be taking up 62.5% of Queensland Motorways, which is about 70 kilometres worth of toll roads in Queensland. And if we have a look at the toll roads, it includes Logan, it includes Between Bridge, it includes Clem 7. And just having a look at Clem 7, I mean, toll roads aren't without their problems, and Clem 7 is a good one and a good example of a toll road that doesn't achieve its traffic numbers and gets into trouble. We know that River City, which went under, spent $1.5 billion on Clem 7, and of course we saw Queensland Motorways coming up and picking it up at a bargain price of around about $600 million, and now we've seen it sold for Transurban probably at a premium. So market estimates for Queensland Motorways was $5 to $6 billion. We've seen it actually selling for $7 billion, which is fantastic news for Queensland Investment Corp, which has managed to pretty much double its investment in a number of years. But for Transurban, it does mean that this purchase will probably not be earnings per share accretive for a number of years. So it is an expensive purchase. It is a long asset, so long life asset for Transurban's portfolio. But all in all, it does mean they will need this rights issue to be able to pay for this asset because of the amount of debt that Transurban already has on its books. So they are looking at a $2.74 billion capital raising. It'll be a renounceable rights issue, 10 for 24, I think it is, at a discount of about 7% to the last traded price. So a huge purchase for Transurban. I think it will be a game changer, but it is an expensive asset, and that really means that they need to get those traffic numbers up, or they need to see efficiencies in their portfolio to start to make money from this particular acquisition. Absolutely, and I think Transurban has made some very cheap purchases. The Cross City Tunnel is one example of probably a distressed asset that it's managed to pick up at a very cheap sum, so that made a lot of sense. This is a little bit of a different scenario where it's paying a premium for our asset, and I think you're right, Noel, that it is a reflection of market sentiment at the moment. We are seeing some of these big assets looking to be offloaded, and some of the other ones that we're looking at are companies like Healthscope, potentially IPOing, but it looks like there's a lot of bidding interest around in that as well. So Queensland Motorways was also one that was slated to go to IPO, but it does look like the interest that they've seen from superannuation funds and funds from all around the world means that it's actually gone to Transurban instead, and there's been a very competitive bidding process. So it is a good sign for the market that we are seeing a lot of these assets selling at a premium. I think companies just need to be a little bit more careful in this type of environment. But of course, as share prices rise up, it's going to be harder and harder to find assets which are trading at a discount. I've seen Atlas Iron really bucking the trend in the production reports that we've seen from the iron ore miners in the Pilbara, because we know that March quarter we have seen the tail end of Cyclone Christine, a lot of rain in January and February, which has impacted on production as well as shipments. But with Atlas Iron, we didn't really see that reflected in the numbers. Despite the bad weather, we saw record shipments of 2.73 million tonnes. Now they are guiding at the upper end of guidance as well. I think with Atlas Iron, you have to remember that this is a leveraged play on iron ore. It does have higher all-in costs than some of its competitors like BC Iron as well as Fortescue. So really watching that iron ore price, and at the moment we're seeing the iron ore price just above that 112 US a tonne mark. So we have seen weakness over the past week in terms of iron ore prices, and I think that's one to watch with Atlas Iron.